Hello and welcome to Leaders of Tomorrow, India's largest platform for entrepreneurs. If it matters to you, it matters to us, and we cover it here in great detail on the show. My name is Sunanda Jaiseelan, and tonight we are continuing our Diwali series by bringing you an expert voice both on the markets as well as the macroeconomy, telling you where you should be putting your money and why you should be putting your money where you should be putting it all of this festive period and going forward into 2022. Let me quickly introduce our guest tonight. Kalpen Parekh, MD CEO DSP Investment Advisors, Director, AMFI. Kalpen, thank you so much for joining us here on the Leaders of Tomorrow, speaking to our entrepreneurs, both about the big picture as well as talking to them about what has worked for you personally when it comes to making and managing money. We're inviting you on the show for the first time, so it's very good to have you here. Speaking to our viewers, especially on the occasion of Diwali. Kalpen, so maybe we could perhaps kick off today's conversation by really talking about all the action that we're seeing in the market over the past 1 year, not just about what's been happening over the past week or so. I want to understand your views on the kind of exuberance that we're seeing in the market and going forward into 2022, another month and a half away. Any views that you can give us about the big picture on the markets, where you see it headed, any outlook, any forecast?
Nanda, I feel that after a phase of extreme pessimism and then optimism over the last 18 months, we feel that economies are stabilizing and a lot of companies are improving their balance sheets, their business models. Companies have taken very aggressive steps to overcome the challenges that COVID had thrown upon all of us by improving their cost structures, increasing their margins, innovating, digitizing, and actually converted a crisis into an opportunity. So companies that matter, and typically for the money management industry, all of us invest typically in leaders across sectors. Companies are demonstrating leadership behavior in terms of navigating through this crisis in a very effective way, and that is reflecting in their profitability. So it's a very constructive picture of strength for corporate India per se. At a micro level, and I think that will continue. The journey of building excellence, the journey of strengthening their business models will continue, and that is a good sign as we end the year. In a matter of next 2 months. On the other hand, when we look at markets and prices are doing what their job is, which is fluctuation. I'll give you a small anecdote. I don't know whether this is a real story, but this has been spoken a lot in many books and over the last 100 years. And this was about a conference which JP Morgan, the founder of JP Morgan, was addressing in New York. He had hundreds of people in front of him. This was in 1914, and someone asked this question in that conference: that what's your view on the market? And he paused for a couple of minutes. He was very thoughtful, and after a lot of deep thought, he just uttered 2 words. And these 2 words are very important. They may sound very basic, but these are very, very important. We should remember this forever if we have to be a good investor. And these 2 words were: markets fluctuate. So they have very deep meaning in that. Markets will fluctuate. Good times as well as bad times will come. Even in good times, prices can come down and vice versa. Last year was a phase of bad times, yet prices went up 100%. So sometimes it's very difficult to understand that why are these trends not falling with each other. But in the short run, in the near term, always markets and prices will fluctuate. And as investors, if we are aware of that, then we can design our investment portfolios accordingly. But my view is markets will fluctuate after very strong moves in one direction, which in the last year has been upward. There will be phases of consolidation. There will be correction. There are a lot of macro data points in India and outside which indicate heightened volatility. Interest rate cycle is reversing. Inflation has started inching up aggressively. All input prices, raw material inputs to businesses. So on one hand, last year was an example where their margins went up because some costs came down. But in phase 2, a lot of input costs are rising and margins are again coming under pressure, whereas stock markets are extrapolating last year's performance into the future. So there will be this conflict of operating trends improving, but also inflation pressure coming in. And some companies will go through a serious amount of volatility. Plus, a lot of companies are priced to perfection. A lot of sectors are priced to perfection. So any deviation from a perfect outcome will have very sharp volatility, which is what we witnessed in the last couple of days. And I think that will be the order of the day.
So you were talking about the investment portfolio. For an entrepreneur who's watching this interview and saying, should I be looking at SIP? Should I be looking at mutual funds? Or should I be looking at high-performing stocks because of the way the markets are performing? What would you have to say to them?
I think, Sunanda, all three are very legitimate means to achieve one single outcome. Why do we invest? Why do we invest in equities? And as you mentioned, most of the listeners or viewers or entrepreneurs, they're all running their business. And when we invest in equity, whether by buying stocks directly or by investing in a mutual fund. In a mutual fund, there are two ways. You put all your money right away, or you do an SIP and put your money over a period of time. All these three modes are doing the same thing, which is buying businesses. So for entrepreneurs, I don't know what value can I add to them, because they are also themselves running businesses, and investing in equities is also as good as running businesses or owning businesses. Yeah. So I think ownership of business is ultimately done to achieve meaningful return on equity. Return on equity for corporate India on an average is around 15%. So when you invest in your own business or others' business, and if that business is run well by good promoters, by good managements, has long runway of growth, is in the right sector, has the right opportunities, and is run by able and honest management, long-term returns help us in achieving superior return on equity over other asset classes, and they help us in growing our purchasing power and even beating inflation. So that is the primary objective, and that remains permanent at all points in time. At this point in time, my approach would be that my first choice would be investing through SIPs. Because it allows you to time diversify. Let's say in the next 2 or 3 years, we see more volatility, because, let me give you one statistic. If you look at history of 30 years of Indian markets, or, since the time Nifty has been around 26 years or so, 1/3 of the times markets go up, 1/3 of the times they go sideways, they remain sideways, and 1/3 of the times they actually come down. But that 1/3 of time when they rise so much more that it overcomes the other two phases. So the fact is, we are coming out of a cycle of rising markets, and hence there is a high chance of consolidating markets ahead. So SIP is the best way to participate in such markets. So my first preference would be to invest through SIPs.
So you're saying SIPs for an entrepreneur who's saying, hey, I've missed this rally, this entire rally that the markets have seen. I wish I had gotten in on the action sooner. Absolutely. Is it too late for them to enter the market? And if they were, would your advice perhaps stay similar to say SIP is still a good route for you?
Sunila, it's a function of time horizons. If my time horizon is 10 and 20 years, which is what my time horizon is, I'm investing for, let's say, my retirement or long-term goals, because, I have enough savings which I don't need for the next 10, 15 years. In that case, whether you do a lump sum or an SIP actually doesn't matter. Because when your time horizons are so long, starting is very important. You may start maybe, 5% higher than what you would have expected, but it's okay. Time will take care of that. So time horizon should determine. And ideally in equity is about building a business and, taking advantage of growth in that business. Businesses are not built in 3 years and 5 years. It takes 7 to 10 years for a full business cycle, market cycle, and economic cycle. And we're also starting at a high. So ideally, a good time horizon for equity as an asset class should be at least 7 years from where we are today. And why SIP, I again repeat, is because prices are high. There will be phases of fluctuation. Of course, if an investor has monthly cash flows, then the best way is anyways an SIP, because your cash flows are also coming every month. SIP is nothing but a reverse EMI. And on the other hand, if you have lump sum today, then there are very beautiful solutions in the form of dynamic asset allocation funds, where I'm also nervous at times that markets have run up a lot, and I got my bonus, let's say, a few months back. What do I do with that? It was a lumpy income. Now, there was nervousness that if I invest in, what if markets crash by 20%? We always are fearful. Yeah. So an asset allocation fund today, for example, has 70% in fixed income or cash, and only 30% is in equity. And when markets fall, it will gradually buy more equities by selling the debt. So instead of me as an investor having to do that and keep tracking it, the asset allocation fund, through a very scientific formula, will keep increasing or reducing the exposure of equity. So I would, just give two inputs, do an SIP and prefer an asset allocation fund. These two are very apt for the market environment where we are today.
Kalpen, I have to take a quick commercial break on that note. We're back in just a moment. Welcome back. You're with us here on Leaders of Tomorrow. And tonight, I'm in conversation with Kalpen Parekh of DSP Investment Managers. I was looking at comments that you've made on what your personal portfolio looks like, and what the asset allocation is like in your personal portfolio. And you've spoken about international funds. There's so much action really taking place on the IPO front as well internationally. What are your views really on international funds? A thumb rule as to what percentage perhaps of your portfolio should be invested in that? How should one go about that? What advice do you have?
Let me give you one more statistic, Sunanda. In the entire market cap of the world, if the whole market cap is 100 rupees, 3 rupees comes to India, and almost 45-50 rupees belongs to US, and then the rest of it is to other markets like China and Europe and stuff like that.
Okay.
So the world's investment book has 3 rupees to India. Our investment book has almost 100 rupees to India, because obviously every investor will have a home country bias. Secondly, whether you do domestic investing or international investing, it is just a label. It is still the same asset class called equity. Because if I go, so let's say I invest in a DSP fund which is investing in international stocks, that is still buying stocks, that is still buying equity as an asset class. So it is inherently it is not any different idea than your domestic investing. It is just that it is able to participate in companies or business models which are not available in India. So if you want to buy innovation, if you want to buy large networks, companies like Amazon, companies like Alphabet and Google and Facebook, such business models are not available in India. So international investing gives you a very different business model. These are pioneers in innovation. They cater to world markets. Their profit pools are not just their country. Their profit pools are even our expenses. So today we are talking on Zoom, and Zoom is a beneficiary. I am talking on HP tablet, so they are the beneficiary. So a lot of our expenses are profits for these global companies.
Yeah.
And hence international investing merits more investments in our portfolio, which are currently fully dominated with Indian stocks. Global markets also will fall 20-30% when equity markets everywhere fall. So I just want to convey that last 10 years have been very fruitful for US markets. So there is perhaps a misconception that those markets are safer and more profitable, but they have as much volatility as Indian markets and similar long-term return profile. The only advantage of international investing, Sunanda, is when you blend the two together, Indian markets and global markets, sometimes they don't move linearly parallelly with each other. So there are phases when Indian markets go up and there are phases when global markets go up, or vice versa. So this relatively lower correlation allows you for the combined portfolio to grow with lesser volatility. So you may still achieve the same returns that you achieve from an Indian market, but the risk comes down. And that is why international investing should be a part of the portfolio. In my case, basis my learning, my nuances and my personal preferences, today I have around 45% of my investments in Indian mutual funds, around 25% in international mutual funds. It's 40 India, 20 global, 30 fixed income, 10 gold. That is how I have deployed my money, depending on my cash flow and my risk profile.
So which brings me to my next question of portfolio rebalancing or asset reallocation. Are there any rules per se that you would want to let us in on?
Yeah, so I think, rebalance should happen when there is imbalance. If there is no imbalance, there is no need to rebalance. So what I mean by this is, let me give you a simple example. You have a portfolio of 50 rupees in equity and 50 in debt. And, we are in March 2020, where equity falls by 40%. So the 50 rupee of equity with a 40% knock becomes 30 rupees. And debt becomes roughly 70. Very simplistically, the 50-50 portfolio becomes 70-30. It becomes more skewed, more imbalanced to debt. and my desired exposure has to be 50-50. So whenever there is a big move like this, is the time to rebalance. Many people very conventionally rebalance once every year, once every 6 months. That has no meaning to me. There is no need to rebalance if your portfolio is still 50-50. What is there to rebalance? Or if your portfolio is 50-48, hardly any change. But whenever, so I personally look at a 10% interval. Whenever portfolio loses its balance by 10% on either side, is when I start thinking about rebalance, number one. Number two, it also is a function of whether the underlying asset has crossed 1 year or 3 years, so that the tax implications are minimal. Otherwise, let's say if within a year, if you rebalance from equity, you have a 15% tax incidence. If you rebalance from debt within a year, you have a full 35% tax rate. So that's the second condition to keep. So just two rules to follow. When your portfolio gets imbalanced by 5, 10 or 15% is when you rebalance. And then second rule is you should not be adversely paying tax, and do it in a very short period of time so that, tax efficient returns don't get compromised.
Do you want to also discuss fixed income and, how you should be approaching fixed income in your portfolio?
Yeah, so I think, long-term compounding, long-term returns, ability to beat inflation, grow purchasing power, all of this is the domain of equity as an asset class, because equity is a growth asset. Equity is where you're owning businesses which will grow and prices go up. And if you look at history, equity returns have been generally 2 times of fixed income. So if average fixed income returns in India were 7%, equity returns have been 14%. Today, interest rates have come down, inflation has come down. So unlikely we'll get 7 or 8% in fixed income today, because interest rates are at 4 and 5%. So what we will earn in fixed income will be 4 and 5%. But it is unlikely that if fixed income rates have come down, equity will continue to give the same 14. So even equity returns will all move down with the cost of capital. World over, cost of capital is low, so returns also will be low. We all need to be aware of that. What we have to focus on is real rate of return. So beating inflation, what is that excess return I am going to make? So while equity is a growth asset class, as I said, market fluctuate. Equity also once in few years has very sharp corrections. When you look back at data, once every 3 years, there is a 15 to 20% price fall, generally in equity as an asset class, world over. Once every 5 years, there is a 25% price correction. Once every 8 years, there is a 40% price correction. Now, there can be 2 types of investors. One who say, I don't care about these intermittent corrections because I know they will happen and they will move on. Markets will come down and they will rise back again. So I will ignore them. I will not even react to them. Then I can put all my money in equity and take the advantage of the highest returns that equity can give me. Then the second type of investor is someone who says every time markets fall by 15-20%, my stocks fall, my mutual fund NAVs come down, it creates huge anxiety. I cannot stay invested. I feel like getting out. Then what happens is we are hurting ourselves because we are buying high, selling low. And then again, when NAVs rise, we come back again. So this behavior does not make money in the long term, because the best way of making money is buying in a down cycle and buying less in an up cycle. So I gave you 2 types of investor. The first type of investor almost doesn't exist. He exists only in theory, who says I will be immune to volatility. All of us are significantly tuned to volatility and we get impacted with volatility. So the role of fixed income is to cushion that volatility. So equity is like a sword when you are in war, which helps you attack your enemy. Fixed income is like a shield, which helps you defend yourself. You cannot go into war with just a sword or with 2 swords, because they can help you move ahead faster, because you can get killed. Or in another example, if you're driving a car and you want to drive fast, if you have 2 accelerators and no brakes, that also will not work. You need a brake as well. So fixed income is like a safety net. Whenever markets, like last year in 2020, when markets fell, fixed income was a huge cushion. And you could take money out from debt and invest in equity. So today, interest rates in India are roughly around 5 to 6%. And mostly you earn returns which are in line with prevailing interest rates. But fixed income is a very important asset class, more so when equity as an asset class has risen a lot. And which is why I personally have almost 25-30% of my portfolio in fixed income, because it gives me the comfort to sleep well in the night. So even today, stocks fall by 30%. I know for next 5 years, my expenses will be taken care of from my fixed income bucket. I'm willing to wait for equity markets to revive, whether it may take 2 years, 3 years, 5 years, and I will not touch it, even if stocks have come down or NAVs have come down. And that is the value of fixed income. The value of fixed income is not the 5% return it gives us. It is the capital protection it gives us when everything else is falling apart. And it gives us that sleep at the end of the day.
All right, Kalpen, thank you so much for your time here on the Leaders of Tomorrow. Wishing you and your family and your team a very happy Diwali.
Thanks, Sunanda, for inviting me, and happy Diwali to all the viewers as well as to you. Thank you.
Completely out of time on this very special episode as part of our ongoing Diwali series. We'll continue bringing you these high-level conversations around the festive period as well as going forward into 2022 all of this month. For tonight, those are wrap. Thank you so much for watching. Have a good night.